Okay, guys. So I'm going to start off with this APM Revision Marathon session. And my agenda for the session of today is going to be that I will make sure that I go through almost every area of this syllabus so that you people have an idea that what exactly is the examinable topic, and so that you could actually have a quick revision of the APM. So let's just start off. Let's just start discussing. So the first thing, when we are actually going to start off with the APM, so there is something that you need to understand. The number one of them is basically the performance management hierarchy. So when I talk about the concept of performance management hierarchy, that's where the APM actually starts off with. The concept of performance management hierarchy is basically that every specific organization have got different levels of management. And what are those different levels of management? If you look at any organization, so you would have these strategic level management, you would have this tactical level management, and then you would have the operational level management. So just like the organization have got the strategic level management, the tactical level management, and the operational level management, similarly, every organization has got different type of goals at different levels. So there are these strategic goals of the organization, there are these tactical goals of the organization, and there are these operational objectives and the operational goals of the organization also. So when we talk about the concept of performance management hierarchy, so you need to understand that every organization that is actually established, every organization that is actually established, the top of the organization, there is something which drives the organization, and that's called a vision statement. And that mission is further subdivided into the vision is subdivided into the mission. The mission is divided into the objectives uh, and goals, and these objectives and goals are further subdivided into critical success factor. So basically, any organization that is actually set up, any organization that is established, the first concept that actually comes in is the concept of vision. What exactly is the vision? The vision actually means the ultimate goal, the ultimate objective of the organization. So whatever the ultimate goal, ultimate objective of the organization, that is going to be considered as its vision. The next thing is basically called the concept of mission. And when we talk about the concept of mission, the concept of mission is that it tells you how the vision is going to be achieved. Then what actually happens is that uh, things to be done to achieve mission. So you've got broader goals, and those broader goals are actually being defined by the mission. The mission is further subdivided into the objectives and the goals. And after the objectives and the goals, there is something which is called critical success factors. And when we talk about the concept of critical success factors, so the critical success factors, which are more commonly also known as the CSFs, this actually means that these are the things to be done to achieve objectives. So ultimately what happens is that if in turn you would see, so the critical success factors are the things that are to be done in order to achieve the mission, and which in turn would actually lead to the achievement of the mission. So every organization, when it is formed, when it is actually formulated, there's actually a concept of setting the vision of the organization. Vision is the ultimate goal. Vision is the ultimate objective of the organization. So you got to set the ultimate goal, ultimate objective of the organization. That is something that you have to actually do. And after setting the ultimate goal, ultimate objective of the organization, what you next do is that you actually define a mission. And after defining a mission, what you do is that you have to have the objectives and the goals. And after setting up those objectives and the goals, the last thing that we actually do is that we actually realize this thing that there's something which is called critical success factors. Now, let's move a bit forward and let's have a bit of a discussion about it. So basically what happens is that this is something that I've told you is about the concept of critical success factor. Now, Basically, when we talk about the performance management, so while studying the performance management, we do study another concept, and that is called performance measurement. I repeat, while studying the performance management, we do come across a concept which is called performance measurement. Now, there is a difference between performance measurement and performance management. I repeat, there's actually a difference between performance measurement and performance management. So let me just explain to you that what exactly is the difference between this performance management and this performance measurement. So when we talk about the concept of performance measurement, the performance measurement actually means that you have to quantify the performance. So when we talk about quantifying the performance, so that is going to be considered as performance measurement. And once we have quantified the performance, what we do is that we take actions to improve the performance, to actually make it good, to make ensure that the performance remains constant. So all of them is going to be considered as performance management. So in short, what you could actually try and understand is that, I repeat, in short, what you could just try and understand is that performance management is something which is a broad action, it's a broad activity. And the performance measurement, it's actually the part of performance management. It's actually part of performance management, right? Okay. Now, basically what happens is that whenever we talk about this performance measurement and management, so you need to understand that in organizations, there is something which actually exists, which is what gets measured, gets done, which is what gets measured, gets done. Now, what exactly do you mean by what gets measured, gets done? Let's have a bit of a understanding of this. So obviously what happens is that those things which are measured, those things which are quantified, the organization's employees, the management, etc., what they do is that they try to make sure that they achieve those things. So basically what happens is that when we talk about the achievement of CSF, it's important that you have to measure the achievement of CSF. And in order to measure the achievement of CSF, what we actually do is that we actually introduce something which is called key performance indicator. We introduce something which is called key performance indicator, the KPIs. Now, when I talk about the concept of KPIs, so there is something that you need to understand with respect to the KPIs. The concept of the KPIs is that there are basically two types of KPIs. One of them is the financial performance indicators. The other one of them is called non-financial performance indicator. So I repeat, when we talk about the KPIs, you can either have the financial performance indicator or you could either have the non-financial performance indicator. Now, what exactly are these financial performance indicator? What exactly are these non-financial performance indicator? Let's have a bit of a discussion about the financial and non-financial performance indicator. When we talk about the concept of financial, non-financial performance indicator, the financial indicators are majorly something that is related to the financial statement, something that is based upon the financial statement. So when you measure the performance based on the financial statement figure, that's actually called financial performance measure. What is it called? It's actually called financial performance measure. Now, so there's one thing which is called financial performance measurement, and that's actually based on the financial statement. Like for example, the different type of ratios, the different type of ratios would actually mean what? The different type of ratios would actually mean that you would talk about what? You would talk about the gross profit margin. You would talk about the net profit margin. You would talk about the current ratio. You would talk about the quick ratio. You would talk about ROCE. You would talk about the asset turnover, things like that. What happens is that when you actually have got these different type of things, so ultimately what happens is that these are all going to be considered as financial performance indicator. Now, the other aspect, which is called the non-financial performance indicator. So you could have many non-financial aspects which could actually be covered up. What exactly do you mean by many non-financial aspects which could be covered up? So you need to understand the many non-financial aspects that could be covered up include what? Include the customer satisfaction, complaint ratio, include the brand rankings. So customer satisfaction, the complaint ratio, the brand rankings, etc., etc. There could be many different type of things that could actually be included in it. So generally speaking, what happens is that when we talk about the non-financial performance indicator, the non-financial performance indicators could actually be like this. Now let's move a bit forward and let's just start discussing further. So basically, what happens is that as an organization, what do you need to do? As an organization, you need to do is that you need to actually continuously introduce the KPIs which are actually going to measure the performance. I repeat, the KPIs which are actually going to measure which are actually going to measure the performance of the organization's achievement of the critical success factor. Now let's move a bit forward and let's discuss further. So basically, in order to measure the performance of the organization, there are basically various different type of, I repeat, there are various different type of models that actually come across. And the most used model is called the balance scorecard approach. Now, when we talk about the balance scorecard approach, so what exactly is this balance scorecard approach? The concept of balance scorecard approach is that under the balance scorecard, you actually try to measure the performance of the organization using four perspectives. What are those four perspectives? One of them is called the financial perspective. The other one of them is called customer perspective. Third one of them is called learning and growth perspective. And the fourth one of them is called internal business perspective. Now let's have a bit of a discussion about it. So when we talk about these all four perspectives, which is the financial perspective, the customer perspective, the learning and growth perspective, the internal business perspective, what exactly are they? So the financial perspective is actually how do we appear for our shareholders? So I repeat, when we talk about the concept of financial perspective, the concept of financial perspective is that how, as an organization, you appear to your shareholders. That's something that happens. When we talk about the second aspect, which is the customer perspective, is that how do customers see us? That how exactly do the customers see us? So that's actually called the customer perspective. The third one of them is called the learning and growth perspective. When we talk about the concept of learning and growth perspective, the concept of learning and growth perspective is that you talk about the learning, you talk about the growth. When we talk about the learning, so learning is that how an organization has improved over a period of time. That may be basically your product manufacturing organization, if you are, then your defect ratio over a period of time, your complaint ratio over a period of time, etc., etc. They all could actually be the measure of learning. And when we talk about the growth, so growth could be the number of products, the growth could be the sales, the growth could be number of stores, the growth could be number of customers, etc., etc. There could be multiple type of the growth things that could actually exist. Then what we have is we have the internal business perspective. When we talk about the concept of internal business perspective, the concept of internal business perspective is that things we must excel at. I repeat, internal business perspective is that things we must excel at. I repeat, the things that we must excel at, that is going to be considered as internal business perspective. Now, let's move a bit forward and let's discuss further. So basically, when we talk about, I repeat, when we talk about the concept of balance scorecard, The concept of balanced scorecard in any specific organization is going to be that you have to measure these four aspects. And therefore, you have to introduce the different type of performance measure for these four aspects. So that could be the NP profit, NP margin, that could be GP margin, that could be ROCE, that could be the economic value added, that could be the EPS of the company. That could actually be the share price. There could be different type of things that you could do as an organization when you wish to go about it. The second thing that is actually going to happen is that the second thing that is actually going to happen is that there is this customer perspective. There could be many things, like you could have the customer satisfaction ratio, you could have the customer retention ratio, you could have the repeat customer, etc., etc. There could be different type of things that you could do in order to measure this specific. Now, so then there is this learning and growth. What exactly is this learning and growth? Learning and growth is actually, it means what? The learning and growth actually means that when we talk about the learning, when we talk about the growth, the learning actually means that you as an organization are learning. You as an organization are actually growing in terms of your skills, in terms of your experience, in terms of your performances over a period of time. That is something that you actually have to do. Now, the next thing is that basically there is this internal business perspective, which is the things that you must excel at. For some organization, it's flexibility. For some organization, it could be innovation. For some organization, it could be the speed, etc., etc. So there is something that is the core function of any organization that is going to be considered as internal business perspective. So I repeat, anything that is going to be the core function of the organization, it's actually going to be considered as internal business perspective. Now, let's move a bit forward. So basically, as an organization, what is it that you need to do? You need to actually understand this specific thing, that in order to implement the balance scorecard, I repeat, in order to implement the balance scorecard, what do you need to do? You need to make sure that you actually have what? You actually introduce the performance measure from these four aspects. What are these four aspects? These four aspects are the internal business perspective, the customer perspective, the financial perspective. All of these things are going to be the case. Now, let's move a bit forward. And then there is this another performance measurement model, which is called the performance pyramid. When we talk about the performance pyramid is majorly inspired by the performance measurement hierarchy. I mean, the performance pyramid is majorly inspired by the performance measurement hierarchy. What exactly do you mean by this? So when we talk about this specific performance measurement hierarchy, I would actually tell you something about it. Let's just see. Basically, what happens is that the performance pyramid actually says that top of the organization is vision. And with vision, there is this something which is market, financial. Then you have got customer satisfaction. You have got flexibility. You have got productivity. Now, so quality, delivery, cycle time, and waste. Now, what does it say? The performance pyramid is actually based upon this specific concept that what happens is that this is the operational level goals of any organization. These are the tactical level goals of the organization. These are the strategic goal of the organization, and these strategic goals ultimately lead you towards the vision. Now, what actually happens is that when we talk about the concept of these different type of things, so the concept of these different type of things is actually going to be that this performance pyramid says that every organization, what it does is that it tries to make sure that it produces the quality goods and services. It tries to make sure that it gives the quality goods and at the same time on time deliveries. Quality goods and at the same time on time deliveries. So what does it say? It says that every organization, what it does is that it tries to make sure that it delivers the quality goods and it makes on time deliveries. And this quality goods plus on time delivery actually leads to the enhancement of the customer satisfaction. I repeat, these quality goods on time deliveries, they ultimately lead to the enhancement of the customer satisfaction, which in turn leads to the achievement of the market related goal. The market related goal could be actually measured as growth in sales, at the same time market share of the company. There could actually be these different type of things which could ultimately happen. So generally speaking, what happens is that the performance pyramid says that the organization, what it does is it tries to introduce the quality goods and services, and it tries to make sure that it delivers the goods and services on time. So this good delivery plus good quality combines increases the customer satisfaction, which in turn increases your market share, which in turn actually helps you achieve the market related goal, the market related objectives. Similarly, when we talk about the concept of cycle time, so cycle time is basically the time for any specific process. Cycle time is basically time for any specific process. So ideally, what you should do as an organization is that you should try to reduce the cycle time. And the second thing that you should try to do is that you should eliminate the wastage. I repeat, what happens is that you try to actually reduce the cycle time. You try to eliminate waste. Now, so what you do is that you try to reduce the cycle time, you try to eliminate the wastage. Now, as a result of this trying to reduce the cycle time and eliminating the wastage, what you do is that you are able to enhance the productivity. You are able to enhance the productivity. What is this productivity of the organization? It's actually doing more work in less resources. It's actually producing more output. It's actually doing better work. So that is what you do. You actually enhance the productivity of the organization. And as a result of enhancing the productivity of the organization, what is it that you are going to do? You are actually going to make sure that the organization is able to achieve its financial goal of enhancing the profitability and etc. etc. Now, overall, what it does is that it leads to achievement of the vision. What? The financial and the market related goal. Why? Because ultimately, if you have got more customers, if you have got greater market share, so having more customers, having greater market share, ultimately uh, combined with having more customers, having more market share, combined with what? Combined with the profits. So ultimately what happens is that this is actually going to lead to, I repeat, this is actually going to lead to the achievement of the vision. So what is it going to do? It is going to lead to the achievement of the vision for the organization. Now, so when you apply the performance pyramid to any organization, I repeat, whenever you apply the performance pyramid to any organization, what you do is that you introduce performance measures. What you do is that you introduce performance measures for each of the above. I repeat, whenever we actually have the I repeat, whenever we actually introduce this performance pyramid to any organization. So performance pyramid actually requires you to introduce performance measures for each of the different levels of the organization. Now, one thing that I want to tell you and that I want you to understand is that basically there is something which is called flexibility. The flexibility actually is adaptability. I mean, the flexibility is actually the adaptability. And this flexibility is going to be affecting both the customer satisfaction and the productivity. Is that okay till now? Any queries still here? Any queries still here? Okay. The next thing that actually happens is that there is actually, okay, the KPIs for flexibility could be the speed of delivery, could be the adaptability to the change. These could be the things that could actually be there. Now, what next is there? The next situation is basically there is another model which is called building block model. Now, what exactly is this building block model all about? So, when I talk about the building block model, the building block model, the building block model was originally introduced for the service-oriented organizations. Now, what actually happens with respect to this building block model is that there are basically three different blocks that we consider. And under these three blocks, what are the things that we consider? I'm just going to explain to you people that what are the three things, what are the things that we actually consider under these each of the blocks. So basically, the top of this is called dimensions block. Then what actually happens is that in addition to the dimensions block, there's also something which is actually called the standard block. There's something that's called a standard block, and there's something which is actually called the rewards, or you could also tell this to be a measures block. Now what happens is that under the dimensions block, you would see that there are different type of things that actually exist with respect to this dimensions block. What are the things that actually exist under the dimension block? Number one of them is financial. The second one of them is basically competitiveness. Quality, innovation, flexibility, and resource utilization. With respect to the standard block, there is actually going to be the ownership. There is actually going to be equity. achievability. Then what actually happens is that in the rewards block, there has to be clarity, motivation, and controllability. So what actually happens is that when we talk about the building block model, how does the building block model operates? The building block model says that this is actually the dimensions block. What is it? It's actually the dimensions block. And what you should do as an organization is that you should introduce performance measure to measure the different dimensions. What are the different dimensions? The financial dimension. Financial dimension against the shareholder, like the EVA, the NP, the ROCE, the GP, etc., etc. Then you talk about the competitiveness. The competitiveness could actually be the revenue, could actually be the market share, could actually be the growth, etc. The quality is again the customer satisfaction, complaint ratio, etc., etc. Then what happens is that there is this innovation. There is this innovation. Innovation is basically either you introduce new services or new products, or basically new methods of delivering the service. Then you have got flexibility, which is again the adaptability. And adaptability is actually going to be measured as speed of service, etc., etc. Then there's this resource utilization. What exactly do you mean by the resource utilization? The concept of resource utilization is going to be the resource utilization could be your input output ratios, etc., etc. So basically what happens is that you have to introduce the performance measures. You have to introduce the performance measures for all of these: financial, competitiveness, quality, innovation, flexibility, and the resource utilization. So what is it that you have to do? You have to introduce the performance measures for all of them. Now what next is there? The next situation that you actually come across is that, just wait a bit. Now, the next thing that you come across is basically the standard block. What does the standard block say? The standard block says that if you are setting the performance measure, if you're setting the performance measure, just make sure that when you are setting the performance measure, you have to make sure that you comply with these standards. Standards of ownership. Ownership means your employees, your managers, whose performance is going to be measured, should actually accept the method, should actually agree to the methods. They should actually accept the method. They should actually agree to the methods. So that is what is going to be considered as, this is, I repeat, going to be considered as your ownership. Then there is this something which is termed as equity. The equity is basically, it's different to equality. The equity could also be termed as fairness. And when we talk about the achievability, achievability actually means that obviously you would be setting different type of targets for different things. Like you would be setting quality targets for the organization. You'd be setting the revenue targets. You'd be setting the targets for the customer complaint, etc., etc. So now what happens is that when you are setting these targets, when you're actually setting these values, you should actually make sure, that they are achievable. I mean, achievable means that the targets that are being set are realistic. Then they should not be unrealistic. They should be realistic. What? They should be realistic. They shouldn't be unrealistic. Then what happens is that there is something which is called rewards. And when we talk about the rewards actually mean that the achievement of the performance should be compensated with the rewards. And what type of rewards should they be? The rewards should have a clarity. Clarity means that it should be clearly defined, that what are your employees going to get. Then the second thing is that about the motivation. The motivation actually means that you would say that it should be acting as a source of encouragement for the employee. Because you see, if you are an employee with a higher salary, and if you are being compensated with a reward which is a very low amount reward, so you would not have the motivation to do that. I bet you don't have the motivation to do that. And lastly, there is this controllability. Controllability means that the rewards of the employees should be based upon controllable factors. Should be based upon the controllable factors. Now, so what have we done? We have actually discussed about these different type of models. Now, from the perspective of the exam, what actually happens is that in addition, in these different type of models are examined in a different manners. And when we talk about the different type of methods of examination of the models, so generally what happens is that there are four different methods through which the questions are examined. One of them is, it says evaluate the performance of ABC company. The second thing could actually be evaluate the performance measures at ABC company. The third one of them is, you would say evaluate the performance management system in the light of balance scorecard, performance pyramid, building block, etc. And lastly, the fourth one of them is going to be, it would say evaluate the performance management report. I bet it says evaluate the performance measurement report. Now, what exactly are these four different type of things? Let's actually try and let's actually understand. Basically, what happens is that when we say evaluate the performance of ABC company, what does it actually mean? evaluate the performance of A, B, C company. This actually means you have to measure the performance and then you have to comment on the performance. I repeat, when it says evaluate the performance, so what actually does it mean? It means that you have to measure the performance, and after measuring the performance of this organization. So that you have to do. The second thing, the second thing that you have to do is that you need to understand something more. Just लेकर आओ. The second thing that you actually need to do is that you need to understand. The second thing that you need to do is that you need to understand when we talk about evaluate the performance measures at ABC company. So when I talk about the evaluate the performance measures at ABC company, so what does it mean with the performance measures? You see, you would actually be given a question. You would actually be given a question, wherein the question what would happen is that we have given the different type of performance measures for you. The examiner would have actually given the different type of performance measures to you. And the examiner would expect that what you would do is that you would comment on those measures. You would actually comment on those measures. That are those measures reasonable? Are those measures appropriate? Given the current situation of the entity, are those measures appropriate for this organization? So like you could come across this different second type of transaction also. The third thing the examiner could do is that he could say evaluate the performance management system in the light of balance scorecard, performance pyramid, building block, etc. Now, when we talk about evaluating the performance management system, what exactly do we mean by this? This would mean that you would compare the existing system. What exactly do you mean by existing system? The existing system means existing method. The existing approach. With what? With the balance scorecard, with a performance pyramid, with a building block model, etc., etc. So that is what you're going to do. So when it says evaluate the performance management system, so this is what it actually is going to be. Lastly, there's this evaluate the performance management report. And this is a regularly examined area. Now, what actually happens is that the performance management report, what does it actually mean? The performance management report is actually going to be a report for the senior management of the organization. And what is this report going to be? The concept of this report is going to be that it is there to actually tell the senior management of the organization that it's actually there for the senior management of the organization to know that how exactly is the organization performing. Now, the question requirement where it says evaluate the performance management report. So when the question requirement, it says that evaluate the performance management report, it would actually mean what? The examiner would actually want to know about what? The examiner would want to say that, look, I've given you this whole performance management report. There's different type of reports that are being given. So you actually comment on them. You comment on this report. You comment on those reports. And generally what happens is that in order to comment on those reports, what we do is that we adopt a method, and the method that we adopt is actually we adopt this benchmark, which is called PAIL, which is you would actually compare the purpose, the audience, the information, and the layout. Now, what exactly do you mean by this? So when I talk about this PAIL, this would actually mean that you would say that what is the purpose? The purpose of what? The purpose of the report is that the management decides that how well the organization has been performing. So when we talk about the purpose of the organization, the purpose of the organization would actually mean that we are talking about the objective of the organization. I repeat, the purpose of the organization would actually mean that we are talking about the objective of the organization. What exactly is going to be the audience? The senior management is majorly going to be the audience. I bet the senior management is majorly going to be the audience of the organization. So who is actually going to be doing it? It's the senior management for which this whole report is going to be made. The third thing is about the information. Like, does this report have the information, which is a mixture of financial or non-financial, or is it just the non-financial information that is there? So basically what you would have to do is that financial or non-financial, etc., that is going to be considered as what? That is going to be considered as what? That is going to be considered as the that is going to be considered as what? The information. And the layout actually means presentation. That how well the information has been presented. Has it been presented in the graphical manner? Are there being graphs? Are there being lines, bar charts, etc., etc.? So that's what it is actually going to be. So basically, what are you going to do? You're going to actually go about evaluating the report and commenting on the report, that to what extent is the report achieving the mission, to what extent is the report achieving the vision, to what extent the report is actually suited to the relevant personnel and the people, to what extent the report is covering both types of information, the financial, the non-financial, etc., etc., and also to what extent to what extent is basically the layout appropriate. Now, let's move a bit forward and let's discuss further. Now, basically, there are different further topics with respect to this APM. So I'm going to talk about each one of them, and I'm going to be discussing about each one of them, that what exactly are these different type of topics. The first thing is basically it's going to be the concept of strategic management accounting. Now, what exactly do you mean by the concept of a strategic management accounting? Basically, what happens is that let me just give you a bit of a guidance that what exactly is the concept of the strategic management accounting. In the old days, in the old days, what used to happen was The major concept of the management accountant, the major understanding of the management accountant was, just wait a bit, please. Okay, so when we talk about the concept of management accounting, just try to understand that what was the traditional management accounting all about. When we used to talk about the traditional role of the management accounting, the traditional role of the management accounting was basically, it was majorly short term, internal focused, cost slash financial related reporting that it was all about. It was all about. Now, over a period of time, what actually happened was that the role of the management accountant, it changed. Over a period of time, the role of the management accountant changed. So in the modern days, the role of the management accountant became more of a strategic nature role. I repeat, the role of the management accountant became more of a strategic nature role. Now, what exactly do you mean by more of a strategic nature role? Let's just try to understand this. That the over a period of time, the role of the management accountant became more external focused. It was more towards giving the information which is going to be relevant for the decision making in the long term. It was more focused towards, achieving the organization's goals and objectives rather than just being having a short term focus pertaining to the specific cost related measures. So basically, as a result of this, the modern day role of the management accountant is actually termed as the strategic management accountant, because his role has become more of a strategic role. That's what it is. So basically, there are different type of techniques in the strategic management accounting. And what are those different type of techniques in the strategic management accounting? The first one of them is actually going to be termed as benchmarking. So when we talk about the benchmarking is basically comparison with the best in the class and trying to reduce gap by becoming similar to the best performing organization, similar to best performing organization. Now, what exactly do you mean by this? When I talk about this benchmarking, so this benchmarking would actually mean what? This benchmarking would actually mean that there could be different type of benchmarking. There could be external benchmarking. There could be internal benchmarking. There could be competitor benchmarking. There could be functional benchmarking. There could be product benchmarking. There could be process benchmark. So when I talk about these all different type of benchmarkings, like external, internal, competitor, functional, product, process, etc. So what exactly is it all going to mean? The concept of external benchmarking is going to be, I repeat, the concept of external benchmarking is that you are comparing yourself to the industry. You're comparing yourself to the outside organization. When we talk about the internal benchmarking is that you are comparing within the organization. Now, when we talk about comparing within the organization would mean what? I repeat, comparing within the organization means that you've got division A, you've got division B, you've got division C, you've got division D. If you're going to compare the performance of all of these divisions, that's actually going to be considered as internal benchmark. Then there is this competitor benchmarking, which is you compare yourself with the competitor. Then there's this functional benchmarking, the different type of functions. There could be production function. There could be the admin function. There could be marketing function. There could be distribution function. There could be different type of functions. So what you do is that you compare yourself, your functions with the functions of the best performing organization. The product benchmarking is basically you compare your product with other product. Process benchmarking is again, there could be different type of process. Like for example, baking is a process. Delivery is a process, etc., etc. There could be different type of processes that could actually exist, that could actually happen. So when we talk about the concept of the benchmarking, just try to understand this concept. I repeat, when I talk about the concept of benchmarking, the concept of benchmarking is that that basically under the benchmarking, I repeat, under the benchmarking, what you do is that you compare yourself with the best performing organization and you try to be like this. So there are certain steps for the benchmarking. There are certain steps for the benchmark. What exactly are the certain steps is that you determine what to benchmark, define the performance indicators, drivers, and hence performance measures to be used in benchmarking. Then what actually happens is that you identify comparator with whom you are actually going to be comparing the performance, calculate performance of comparator, compare performance and identify gaps. Number 6, take corrective actions. And number 7 is monitor. Number 7 is gonna be monitor. So when we talk about the concept of the benchmarking, let me just try to explain to you. The concept of benchmarking is gonna be that there are different steps that an organization would actually adopt. What are the different steps that the organization is gonna adopt? The number one of them is that you need to identify what to benchmark. Is it the function that you have to benchmark? Is it the process that you have to benchmark? Is it the product that you have to benchmark? What exactly do you have to benchmark? Then you have to define the performance indicator, like sales as an indicator. Then the drivers, like the sales is being driven by maybe capital. The sales maybe compare or sales may be driven by the capital. So performance indicator and driver, so you resultingly get the performance measures. Like for example, one of the performance indicator could be sales. The driver could be capital. One of the performance indicator could be profit, driver could be capital, driver could be sales. So that's why we have got the asset turnover ratio. That's why we have got GP margin, etc., etc. So hence this is going to be performance measures. I bet this is going to be what? This is going to be the performance measures. So what you do is that you calculate the performance measures. You determine which performance measures to actually use. Then what actually happens is that you identify the comparator, the organization with which you are going to be comparing yourself. You calculate the performance of the comparator using all these indicators and drivers. You compare performance of both the organizations and then you identify the gaps. Once you have identified the gaps, resultingly, what happens next? Resultingly, what happens next is that you take the corrective actions. What do? You take the corrective actions, and end of the day, you continuously keep on monitoring if the corrective actions have actually reaped any benefits or not. Let's move a bit forward and let's discuss a bit further. The next basically concept is another technique which is called BCG Matrix, the Boston Consulting Group Growth Share Matrix. The Boston Consulting Group Growth Share Matrix is basically termed as portfolio planning tool. It is also termed as resource allocation model. So I bet when we talk about the BCG matrix, it could be termed as portfolio planning tool. It is also termed as the resource allocation model. Now let's have a bit of a discussion that what exactly is this BCG matrix all about. So in accordance with the BCG matrix, what do? You actually create a matrix for yourself in which on one axis you define the market share, and on another axis you define the market growth. So basically what happens is that the market share could be low, market share could be high. Market growth could be low, market growth could be high. So what you do is that you classify your products which are actually on these different bases. You classify a low market growth and a low market share product to be a dog. Then low market share and a high market growth to be a question mark. There's another name for it, and that's called problem child. I bet there is another name for it, which is called the problem child. Then what actually happens is that when we talk about the market share, so basically high market share, low market growth. So this is basically called cash cow, and this is called a star. Now let me just give you one by one a bit of a guidance. Basically what happens is that this BCG matrix says that the dog category product are those which actually consumes resources. Question mark product is poorly performing product as per BCG matrix. Star is growing product. Cash cow is profitable product. Now, what actually happens is that you think about it. that if you are actually in a market where the growth rate is low and you've got a low market share, so resultingly you are in a position that according to BCG, you are in a loss making situation. You as a division, you as a subsidiary, etc., you're consuming the resources of the organization without giving any benefit to the organization. So this specific dog, I mean, this is specific dog in accordance with the BCG matrix, it should be divested. Similarly, when we talk about the BCG matrix, the cash cows are those businesses, those departments, those products, etc., which have got a huge market share and which are actually in an industry where there is not going to be much of a growth. So if they are in an industry where there is not going to be much of a growth, so what you have is you have as an organization an advantage that you have as an organization as an advantage that you could get more benefits, more profits by making low investments. So BCG matrix says that you got to manage these. I bet the BCG matrix says that you got to manage these. What? You got to manage these. What do you have to manage? You have to manage these cash cows. Like you just have to do nothing. They're just gonna reap the benefits on their own. All that you have to do is that you just have to manage them. What do you have to do? You just have to manage them. Then there is this basically problem child. But before I go on to problem child, I'll just talk about the stars. The stars are basically highly profitable, high growth products. And what you need to do as a strategy, you got to invest in them. The stars are somebody you could think of a baby in the growing age, a baby which is actually growing. So that could be considered as a star. I mean, that could actually be considered as a star. Now, when we talk about the concept of this, so this is a star and then the problem child is basically the BCG matrix says you got to analyze it. Now, how does BCG matrix operates? So BCG matrix says that look, what actually happens is that these question marks could be future stars, they could be future dogs. These dogs are going to consume resources. These stars are going to be your future cash cow. These stars are going to be your future cash flow. So as an organization, what you should try to do is that you should try to maximize. You should try to maximize the star and you should try to maximize the cash flow. So I bet what you need to do is that you need to maximize the stars and you need to maximize the cash cow. That is something that you have to do. So basically that was about the BCG matrix. Now let's move a bit forward and let's have a discussion about further. So basically what happens is that there is another concept which is part and parcel of the strategic management accounting, and that was basically one of the theory from the theorist, the name of which whom was Burns and Scapens. Burns and Scapens, what did they do? They actually presented a theory which was about the changing role of management accountants. So basically what does it says? It says that the modern organization, I mean like obviously the traditional organization, the role of management accountant was different, and the modern organization, the role of management accountant is different. So traditionally the management accountant was more focused on financial control, and modern organizations, they're more focused on the business support. Similarly, when we talk about the traditional organization, so what happens is that these traditional organization, what used to happen was that the management accountant function, the management accountant function was basically uh, separate from business operations. It was more of a costing type of a function. But now what happens is that these functions are integrated within the finance. So what does Burns and Scapens says? Burns and Scapens says there are four forces. There are four forces of change. Like if we talk about this, there are basically four forces of change. What are those four forces of change? The four forces of change, that is basically the things which actually are pushing the change. So that's actually number one, technology. The adaptability of the technology is resulting in a change taking place. Then there's this management structure. So basically, when we talk about the changes, the forces of change. So the forces of change are mainly the technology, the management structure, the organizational structure, and the competition. So basically what happens is that the adaptation of the technology, that is basically the new methods, the new IT system, the new information systems, that's all forcing a change. Then what happens is that um, the management structure. So management structures are changing is that there is now becoming lack of you could rather say that more delegation. Then there is this competition. Obviously, there are more competition. So that is actually going to bring about a change to the organization. And lastly, what happens is that the organizational structure, the organizational structure, the organizational structure like nowadays, we have got the network alliances, network organization, we have got the alliances, we have got the virtual organizations, etc., etc. So these are all things that actually have brought about the changes. So basically, the role of management accountant has changed nowadays in the modern era, and the management accountant is not just somebody who's good, who's gonna do the performance, who's just gonna do this performance measurement, but the management accountant's role has now become a bit of an advance. Is somebody who's actually going to help you with the performance management. He's going to guide you what's going on with the organization. He's going to guide you what should be the future strategy. He's going to guide you how the organization could remain competent, how the organization could remain uh, more competent. So that is what the management accountant is now going to guide you as an organization. Okay, let's move a bit forward and let's talk a bit further. So there is now another concept which is called the concept of budgeting. When we talk about the concept of budgeting, so what actually happens with respect to the budget? The concept of budgeting is actually going to be that whenever we talk about the concept of budget, budget is basically your future financial plan. Whatever your future financial plan, that's gonna be considered as budget. I repeat, whatever your future financial plan, that's actually gonna be considered as budget. Now, there are different type of approaches that the organizations adopt with respect to the budget setting. Amongst those approaches, one of the approach is basically a fixed budget. What happens under the fixed budget is that so that's actually called the fixed budget. The second budget is called the flexible budget. What actually is the flexible budget? The flexible budget is basically when you've got number of budgets made at different activity levels. So basically what happens is that rather than having one single budget, you've got multiple budgets at multiple activity levels so that you could use the appropriate budget when making the comparison. Then what happens is that incremental budget. The incremental budgeting is basically either you start off from the existing P&L all the last year budget, and what you do is that you incorporate the incremental effects on that. That could be 10%, 15%, so on and so forth. Then the fourth one of them is basically activity-based budget. Now, what exactly do you mean by activity-based budget? The concept of activity-based budget is that what you do is that you use the ABC data. Abid, what you do is that you use the ABC data. And on the basis of ABC data, what you do is that you set the budget. You set the budget using the ABC data. The fifth one of them so there's this rolling budget. Rolling budget is basically a budget that is continuously changing and is being updated. The last one of them is called zero-based budgeting. When we talk about the zero-based budgeting, the zero-based budgeting is generally suited for those organizations which are a sort of a project type organization, which are actually doing the business for the very first time. So zero-based budgeting actually is a bit suitable for them. Now, what actually happens with respect to the zero-based budget is that you start from the zero base. Means what happens is that you start with as if there has been no budget. You start as if there has never been any budget. You start as if this is the first time ever that the budget is being set, the expenditure, every single budgetary allocation is without the justification, nothing actually happens. So every single thing that actually is there is being justified. So when it comes to the zero-based budgeting, let me repeat again. So what happens with respect to the zero-based budgeting is that this zero-based budgeting is one of those budgeting techniques where every single uh, every single this budget allocation is being justified. That without the justification, what happens is that you just cannot have budgetary allocation given to any department in the organization. So that's what actually happened with respect to the zero-based budgeting. Now, let's move a bit forward and let's have a bit of a discussion further. So basically, I've told you what a zero-based budget is going to be. I've told you what a zero-based budget is actually going to be. Now, basically, when we talk about the budget exercise in any organization, so you would come across a scenario where you would have these different type of budgets being set. You would come across scenarios where you would have these different type of budgets being set, and you might actually have to comment that which of the budget setting technique is an appropriate technique, which of the budgeting technique is an appropriate technique under the given situation, under the given circumstances. That is something that you might actually have to talk about. Now, let's move a bit forward and let's discuss a bit further. The next concept of this is that at times there is something which is called the approaches to budgeting. At times there is something which is actually termed as approaches to budgeting. Now, what exactly do you mean by this approaches to budgeting? So let's have a discussion about the approaches to budgeting. The approaches to budgeting could be that there could be two different types of approaches that could be used for the budget setting. It could actually be two different type of approaches that could be used for the budget setting. What are those two different type of approaches that could be used for the budget setting? Is there disturbance still there? Vivek, is the disturbance still there?
I think it maybe a little bit. I don't know, maybe a little bit.
Is it better now?
I think so, yes.
Okay, good enough. Okay, so what happens is that when it comes to a repeat, it comes to this budget setting exercise. So there are different type of approaches that you could adopt as an organization. And what could be the different type of approaches that could be adapted? One of them is called top-down budgeting, and the other one of them is called bottom-up budgeting. The top-down budgeting is actually a sort of approach which is authoritative, and the bottom-up budgeting is something which is basically participative. Now, so one of them is basically the authoritative, the other one of them is bottom up, which is participative approach. Now, what actually happens under this authoritative approach is that the senior management would set the budget and it would pass on the budget to the junior levels within the organization. When it comes to the bottom up budgeting approach, the bottom up budgeting approach is actually going to be, you have the junior level management propose the budget, and the senior management would just actually sort of approve after some discussions, after some queries and things like that. So that is basically going to be considered as what? That is going to be considered as the as right? So you get it. So basically what happens is that depending upon every organization could have a different type of approach. I bet every organization could have a different type of approach with respect to the implementation of this budgeting. And again, every specific approach have got certain advantages, certain disadvantages. So what you would have to do is that you would have to keep those things in mind. Okay, now what I would do now is that I would invite the floor to you people. And in case if any one of you would like to have any specific queries, any specific issues, any specific areas that you would want me to explain, so I could just go about explaining them. I'm gonna start off. Okay, yeah, let me just explain about the beyond budgeting. Um, so when we talk about the concept of beyond budgeting, so what exactly do we mean by this beyond budgeting? Beyond budgeting is basically one of the techniques where you do is that you say within the organization that the traditional approach of budgeting is going to be abolished. We're not going to be setting the budgets anymore. So if you're not going to be setting the budgets anymore, what exactly are you going to be doing? You would actually delegate this to the departments to actually set their own budgets. The department A, department B, department C, department D, etc., etc. And what you would do is that, let's say department A says that we need 10 million dollars as a budget. Okay, so we allocate this $10 million depending upon the availability of the fund. We allocate the 10 million to the management. And what happens is that we now tell them that, look, we don't care that where do you use. We don't care what you are going to do. We have just given you this 10 million budget as per your needs. We have just given you this 10 million. Now you set your own budget. You decide how much amount are you going to be spending on marketing? How much amount will you be spending on sales? How much amount would you be doing on production? How much amount on the administration, etc., etc. What we are going to do is that we're going to identify the benchmark organizations and we're gonna compare your performance with those organizations. Now what actually happens is that when you go about doing this beyond budgeting thing, that is you abolish the traditional budgeting approach. You don't bound your employee with the budgeting. You don't compel them to the budgets. You rather give them the authority to set their own budgets. So automatically what happens is that their encouragement level goes up. Their encouragement level goes up. The encouragement level goes up, and the encouragement level goes up means that they are actually going to be what they are actually going to be um, they're actually going to be more motivated and more encouragement is going to be there. So they would try to achieve greater and the better performance. So that is what the concept of beyond budgeting is all about. Now I'm just going to open up the floor for you people to ask anything that you would like to ask. And I would just try to answer. In case if I'm not able to, I might actually excuse you that I will revert back to you. Now, if I have got Ahumuza Esilimi Yuvon. Yeah, you have anything to ask? Asumu Ahumuza Esimivi. I'm sorry, I don't know if I'm pronouncing your name correctly or not. I'm sorry.
No, I don't have anything to ask as of now.
So this revision was of benefit for you?
Yes, please.
Okay, lovely. Okay, then I've got then Anna and Mary. What is your name? And Mary Tingling. And Mary Tingling, you have any query?
Sorry, I don't have any query for now.
Okay, lovely. So the revision was beneficial for you?
Very beneficial. Thank you.
Lovely. Thank you. I'm going to share some YouTube links also so you people could actually go through them also. Okay, then I've got at Marie Mohanty. Any important topics? Okay, wait for 2 days. I'll revert back to you people with this. On the 1st of September, I'll share some important topic list. Do you have any other thing to ask?
No, sir.
Okay, you're from India?
Yes, sir.
You people beat us yesterday.
Yes, sir.
It was a lovely match.
Indeed.
Yeah. Okay. See you, lady. Thank you. Okay. Then I have got Deborah Akindeko.
Yes, good evening. And
Good
thank you for the
evening.
revision. Yeah.
You're welcome. I'll share some YouTube links also. We'll share this playlist where you could benefit more from that, right? There are more playlists that I have to be shared with you people.
Thank you, sir.
You're welcome. Okay, Franklin Famous, any specific query that you have?
No, thank you.
Welcome. You're welcome. Okay. Yanel, any specific query that you have?
No, sir, at the moment.
Not.
Thank
Okay.
you.
So the revision was beneficial for you?
Yes, sir.
Okay, Uchi Kapudua. Yes, I'll just do that. Don't worry about it. I'll just do that. Okay, so who do I have? Julius Kiser. I hope that I'm pronouncing your name correctly. Julius Kiser.
Yeah, yes, you did.
Okay, Alhamdulillah. So which country? Uganda? Are you from?
Yeah, I'm from Uganda.
Okay, lovely.
And thank you for the presentation. It was very nice.
Thank you. Most welcome. Most welcome. Okay, I've got Kimberly Lewis. Kimberly. Yeah, Keisha, just wait a bit.
Everything was quite clear. If you could just probably speak about the service industry or like KPIs for the not-for-profit organization, and any approaches to those types of questions would be useful.
Okay, I'm just going to write that down because I've got certain furthermore queries coming in.
Okay.
So it's basically not-for-profit versus profit-oriented. Okay,
Yeah.
I've just written down that. Now, I have. Okay, there are certain more queries that I'm just getting across. Keisha Sutherland, how are you? Hello.
Hello, good day. Sorry.
Yeah, I
yes.
can hear you now very clearly.
Yes, sorry about that. Wonderful presentation. I joined a little bit late, but wonderful presentation in terms of the simplicity and how all the points are connected. I am very happy that you were able to show the connection between the budgeting and the BCG Matrix and so on. I just like the connection. My issue though is normally with risk and uncertainty, and it's not necessarily the topic and the content of the topic, but it's more like the setting up in the exam, like where do you put the demand and the unknown variables and so on. So and it takes a lot of time out of me. Even when I'm practicing, it's just too much time, and I take way too long to kind of understand what is going on. So if you can, if you have any way in terms of simplicity as it relates to that, I still have to go over your videos because I signed up for your class, just to see how that works again. But I will appreciate any help.
Okay, I've just written that down because there are a few queries that I have. So I've just written them down, and I'm just going to do it once I have a discussion with all, right? Okay, Madeline, is it your name Enzima or Ezinma?
Ezema. But my name is
Okay.
Madeline.
Madeline, right? From Nigeria, right?
Yes.
So any queries that you have, lady?
Sure. I think I've been following and I've been enjoying the revision class. It's okay. Well, maybe as we go on, I will have my query because I would just like them, most especially the alternative performance management models, to show for you to help us show how it links properly. Maybe when it's given in a scenario, how one can have an overview, an holistic view of the model itself.
Okay, I'll just try to cover it up.
Okay, thank you.
Thank you. Okay, Rahil, how are you?
Good, sir.
Any specific query that you have?
Not at the moment. Your lecture is going great at this moment. Whatever the concept is there in between, you are explaining very precisely and comprehensively. It making sense, as earlier my peers have said. It's making understandable to us. Hope it will go as in the exam as well.
Inshallah. 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 Inshallah.
Thank you.
Thank you, Rahil. Thank you, Rahil. Okay, Rosemary, how are you?
Hi, sir. Thank you so much. I'm fine, thanks.
So
I'm actually repeating my exam. So I got 49 last time.
Very, very sad.
Yeah, well, yes, but it is what it is. I just would like to ask if you are going to say anything about, I remember they have a question about pay-related adverse, and I didn't know, I thought they was talking about the rewards and goals linked to performance, but I'm not sure if this is what they was looking for.
Okay, so I've just written that down. Any other query that you have?
No, more about that. Thank you so much.
So the revision was good for you?
Oh, was great, great.
Okay, lovely. Thank you.
Cheers.
Mr. Saidu, how are you? Hello, Mr. Saidu.
Yes, good evening.
Good evening. How are you?
I'm fine, sir. How are you, sir?
I'm good. I think that we have had interaction earlier also, right?
Yes. At the SBR class. Just
in the SBR class.
Yeah.
In the last session, right?
Yes, the last session, and then even this session. I after taking the last exam, I thought I could make it, so I went to be for the APM, and then the SBL.
Mm-hmm.
But now I'm just doing this, the APM as a, just like, though I will not be taking the exam, just to follow up so that I can like build my knowledge before actually going for it.
Mm-hmm. Okay, no worries. So you have any queries for today?
No. I actually joined late, so but I do not have any question for now. I will follow through as we go by.
Okay, lovely. I'm just collecting the queries so that I can just go about that way, right? Just wait a bit. Okay, so then I am not too sure if I'm pronouncing your name correctly, Sanvelo and Antilol. I don't know, sorry, Sanvelo.
Yes, good evening.
Good evening. I pronounced your name correctly?
Almost. Senuelo.
Sanvelo. So which
Yes.
country are you from?
From Botswana.
Botswana. 267 is your country code.
Yes.
Okay, it's the first time that I've heard a name like this. So anyways, so how are you, and do you have any queries specific?
No queries. I thoroughly enjoyed today's session. I don't know if it is possible to maybe have an overview of a question or questions that have to do with the new topics beyond budgeting and data silos. I don't know if that is possible.
May not be possible today, but I've got some things which I could actually share with you people over the YouTube. So that's actually going to be helpful for you people.
Okay, thank you, sir.
Okay, thank you. Okay, then I have got another one, which is Simi Lolua Oni. Simi Lolua Oni. Hello. How do you pronounce your name?
Simi, you can just call me Simi. My Simi
Okay, again,
Lolua, you pronounce it correctly.
you made things easy for us. Which country are you from?
I'm from Nigeria.
Okay. So you have any queries for today?
I think it has been mentioned. I mentioned EVA and risk. So, and I'm also looking forward to all the other things you'll be sharing. But this class has been very insightful, and yeah, I'm very grateful. Thank you very much.
You're welcome. Okay, so I'm just gonna share that. Don't worry about it.
Thank you very much.
Okay. Okay, then I've got Uchi Kapadua. I'm sorry, at times I don't know how to pronounce the names. Uchi Kapadua.
Good evening, sir.
Good evening. What's your name?
Okay, my name is Uche Padua.
Uchi Kapadua. So I pronounced it correctly, right?
No, don't mention K. Just say Pa.
Okay, Uchi Padua. Padua.
Yes.
Okay. And which country are you from?
Nigeria.
How come that we have so many people from Nigeria?
Because a lot of us are writing the exam.
Okay, lovely. So you have any queries for today? I think you did mention something. I've just written them down.
Yes, thank you, sir. Yes, I talked about transfer pricing. You've already
I've written that
taken
down.
note of that.
I have taken note of it. I'm just gonna do it now.
Okay, thank you, sir.
Okay, thanks. Thank you. Okay, then I've got Vidhi Desai. Vidhi Desai.
Hi, sir.
Hi. Are you from India or
Yes, sir.
Mauritius?
From India.
Okay. Yes,
Yes.
please. You have any queries?
The lecture is quite going great for me, and very grateful for it. I have two things to ask. Firstly, the benchmarking we already spoke of. I wanted to know the link between the benchmarking and league tables. It's quite little confusing when it comes to
Okay.
and
Okay.
if possible, like important topics which we should revise.
Everything is important. Okay, just for the important topic, just wait till 1st September. I'll just share a list.
Okay, thank you so much, sir.
Okay, you're welcome.
Yeah.
Okay, lovely. Vivek, how are you?
Hello. I'm very good. Thank you for asking. How are you?
I'm good. You're from UK or what?
No. I live in India at the moment, but I'm from Japan. I'm Indian though.
Sorry for keeping. I kept you waiting the other day because it was a technical issue that I had, so that's why I just made sure that I make the most of the today's class.
No problem. Thank you very much for doing this. Actually, it's very useful.
You have any queries? Specific queries? Any?
I was actually thinking because I'm not very strong with budgeting and anything of that sort. So I hope we don't get any questions on budgeting. But then, if it does turn up, do we usually should we be expecting some sort of numbers? Because I haven't done my performance management yet.
You see, what I'm gonna do is that I'm gonna make things easy for you people. Just give me a minute because I think that I should actually tell you people right now. If you could actually see this YouTube window right now, I hope that I'm able to share it. Now, YouTube window, you go into the YouTube, you search out a channel which is called a Scriber Academy, our college channel. When you go in there, you go onto the playlist. On the playlist, what you need to do is that you need to sort by latest video added. So when you're going to go through it, you would find that there is basically a playlist for APM, the Advanced Performance Management, somewhere here, APM, view people, APM. So when you would go through this specific playlist, what is going to happen is that there is a comprehensive, complete revisions, etc. videos on the APM. There is an ample amount of resources. So for those who are actually looking for something like some of you have asked for the EVA, there's a comprehensive EVA video. There is this comprehensive the budgeting question. This divisionalization transfer pricing question. So there are comprehensive things which are available over here. So you could just go on to this Scriber Academy, the channel's name, Scriber Academy, and you could search for this playlist, which is basically, I just hope that I'm able to share this somewhere. Hi guys, welcome to this APM introductory session for December. Let me just see that if I can actually share it with you people. So it's actually going to be good. So we just try to share this with you people. So you go about with this, and once you actually go about with this, so what would happen is that you would be able to have a complete access to a lot of things, because there is still ample amount of time available for doing the papers, for doing the exam, for preparing for the exam in case if you have got only one examination. Obviously, in case if you have got multiple examinations, then obviously you don't have the time. But if you have got only one examination, you've got ample amount of time. And what you could simply do is that you could just go about doing it. So I'm just gonna, you can try and check out the Scriber Academy channel also. But at the same time, what I would do is that I would just try to see if I can get this one through to you people on the WhatsApp group. I don't know if you people have been added to the WhatsApp group or not. I'm not too sure. Just wait a bit. My daughter just took away my Okay, I'm sorry, I cannot share right now on the WhatsApp because my daughter, she has taken my phone away, and I'll try to actually do it immediately after the class. But in the meantime, you people could search it on the YouTube, the Scriber Academy.
Sure. Thank you so much for doing this, by the way. This is very good. Thank you.
Welcome. Okay, then I have got Yvonne Morrison. Yvonne, you have any questions, anything that you would like to ask? Good day. Good day. Yeah. Okay. Simi, you would be added up to the WhatsApp group by tomorrow. Okay, lastly, I have got Zuhair Hassan. Yeah. Zuhair Hassan, Zuhair, do you have any queries?
Sir, not at the moment. Actually, I do. So the 20 professional mark, if you could just, if you could have your advice on that.
Okay, no worries. I'll just try to cover them up. Okay, now let me take you people through some of the topics. Obviously, some of the topics I won't be able to do right now, but some of the topics I can do. Now there is basically one of the inquiry that was about the not-for-profit organization. Let me just guide you a bit. Generally speaking, what happens is that there are two different type of organizations. There could actually be profit-oriented organizations, and there could be not-for-profit organizations. Now, when we talk about the not-for-profit organizations, what exactly is the distinguishing factor of the not-for-profit organization? The major aspect of not-for-profit organization is, although it may exist for welfare purposes, but major thing that is the distinguishing factor is that the profits are reinvested. The profits are reinvested. So whenever we talk about a not-for-profit organization, the major distinguishing factor for a not-for-profit organization is that the profits are reinvested into the business with the objective that ultimately you would go about for the furtherance of the certain activity. Now, when we talk about these not-for-profit and the profit-oriented organization, there are a few things that you need to understand, which is basically that the method of measuring the performance for not-for-profit organization is a bit different, because when we talk about the profit-oriented organization, you could go about doing economic value added, you could go about doing this net profit margin, the return on capital employed, etc., etc. But here the problem is that the objective of this organization is not to earn the net profit. The objective of this organization is not to earn the return on capital employed. The objective of this organization is not to earn the economic value added. The objective of this organization is to serve the people at large, to actually serve the people at large, to serve the societies, to serve the public. That's what the objective of the organization is. Now, what is actually going to happen is that generally what we do is that whenever we have to measure the performance of the not-for-profit organization, so what we do is that we generally perform value for money audits. So when we talk about this value for money audits, what exactly are these value for money audits going to be? The value for money audits are going to be that you would focus upon the 3 E's. What are the 3 E's? The 3 E's are the economy, efficiency, and effectiveness. Now, what exactly is this economy all about? What is this efficiency all about? And what is the effectiveness all about? So when we talk about the economy is basically doing a task at low price. So when you are actually able to do, in fact, rather than using the word price, I would use the word low cost. So doing a task, doing something at a low cost would actually mean that you've been able to achieve the economy. So a not-for-profit organization would try to be economic. A not-for-profit organization would try to make sure that it achieves economies of a scale, would try to make sure that it does any task that it does at a lower cost. Then there is this efficiency, which is utilizing less resources. And lastly, you've got effectiveness. Effectiveness is achieving the objective. So when you've got the objective which is being achieved, so you would say that the effectiveness is being achieved. Now, for example, let's just talk about a public hospital. So if you've got a public hospital is doing some procedure. Let's say if the public hospital is doing an operation, so the cost per operation is going to be something that's going to tell you that the hospital is doing something at an economical price or not. If the hospital is doing the task economically or not. The efficiency is basically, the efficiency is the time taken. Mera mobile gaya? Okay. The efficiency is actually what? When we talk about the efficiency, the efficiency is actually talking about doing something in the low amount of resources, low amount of time. So it's basically time taken to do an operation. So that is going to be considered as your showing of the efficiency. And lastly, when I talk about the concept of effectiveness, effectiveness is basically, you could say the cure ratio for a patient. You could say that the cure ratio of the patient is going to be one of the factors that's going to be talking about the effectiveness. So now what happens is that whenever we talk about any public sector organization or any not-for-profit organization, like it's not just the not-for-profit organization, but even when you are talking about the public sector organization, what do we mean by public sector organization? It could actually be the police, it could actually be the utility company, it could actually be any other type of a company. So the objective, the agenda of the public sector organization is also the same. That is, it wants to serve the public at a large. And what happens is that it does not generate those revenues and etc. So ultimately what happens is that whenever we have got this public sector organization, you apply the value for money audit for the public sector organizations also. Now, let's just try to have a bit of an understanding. Let's just try to have a bit of a discussion of this. So basically what happens is that we perform the value for money audits. I repeat, what we do is that we perform value for money audits for the public sector organizations also. Now, let me guide you something. Basically, there is actually a problem that when you talk about these three E's, they're all something that contradict with each other. Whether we talk about the economy, whether we talk about the efficiency, or whether we talk about the effectiveness. I repeat, whether we talk about the economy or whether we talk about the effectiveness or whether we talk about the efficiency, they are all contradictory. Like for example, if you wish to go about economy, so you might compromise the effectiveness. If you wish to go about the efficiency, again, the effectiveness might be compromised. You wish to go about with the effectiveness, the economy or the efficiency could be compromised. So there could be multiple type of things that could happen. So generally, one thing that you got to understand that they are all contradictory. So as an organization, what you need to do is that you need to strike a balance between all three of them, which is the economy, efficiency, and effectiveness. Okay, now now let me just guide you about another concept which is called the concept of just wait a bit, please. Can you allow me 2-3 minutes? let me just fix these kids. Just wait a minute, please. Okay. Now next, when I talk about the concept of league tables, let me just give you a bit of an idea that what exactly is this league table all about. Now, in order to understand the league table, you need to understand the football leagues. Like for example, when you have got a football leagues, so you've got somebody who wins gets 2 points. Somebody who plays a draw gets 1 point. Somebody who loses gets 0 points. Now what happens is that, let's try to understand this. Basically, let's say you've got a league table is actually derived from the football leagues. Let's say that you have got Manchester United, you've got Chelsea, you've got Liverpool, you've got Arsenal. Now let's try to have an understanding of this. Manchester United cannot play itself, Chelsea cannot play itself, Liverpool cannot play itself, Arsenal cannot play itself. Now let's see. The Manchester United, when it played Chelsea, it won. When it played Liverpool, it had a draw. So what actually happens is that, and when it plays Arsenal, it's ending up at 0. Now, similarly, when we talk about Chelsea, so it actually lost against the Manchester United. It had a draw with Liverpool. It had a draw with Arsenal. So the Arsenal had a draw with Chelsea. The Liverpool had a draw with Chelsea. Now what actually happens is that Liverpool, when it played the Arsenal, it lost. So Arsenal actually won against Liverpool. So now what actually happens is that as a result of this, you would see that maybe if I could just give you general test results, general match results, you might not be able to interpret that who actually won. But when we create a table like this, we see they have got 3 points. We see they've got 2 points. They've got 2 points and they've got 5 points. So we could see that these are actually the leaders and they are the followers, and then Chelsea and Liverpool at the bottom of the table. The football league tables are actually designed to help grade, to help identify that which specific club, which specific team is at which specific level. Now, how do we actually apply the league tables to the public sector organization? So for example, you're talking about a school. A school may be set by school may be set different type of KPIs by the government, like maybe possible the number of student ratio, the student to teacher ratio, distinction, area covered, number of sports offered, etc., etc. So the government could give 10, 20 types of benchmarks or the KPIs that every school actually has to score themselves against. Now, if I say, let's say this is 50,000, or let's say if I say this is 40, etc. So this is not going to give a meaningful picture. So what you should ideally do is that you should actually create a sort of a table. That way you would say that if you are meeting the target, you get 1 point. You are exceeding the target, you get 2 points. Where you are not meeting the target, you get a 0 point. So maybe what could happen is that 2, 1, 0, 0, 0, 2, 2, 2, 2, 1, 1, 1, 0, 1, 0, 2, 0, 2, 2, 0, 1, 2, 1, 2, etc., etc., etc. in different types of these specific KPIs. The different organizations could have a different score. So resultingly, this league table is going to help you interpret and help you analyze the result, make it simpler for you to interpret the result. That's what the league table is going to do. Now, let me see. Okay, for the not-for-profit and profit-oriented, I did that. For the league tables, I did that. I'm not doing divisionalization and transfer pricing. I'll just give you the video. It's already there. For the risk and uncertainty, a video is there already, but let me just guide you something about the risk and uncertainty because there was some queries now. And I think that the complicated area. Okay, first of all, when we talk about the risk and uncertainty, so what exactly is the difference between risk and what exactly is the difference between uncertainty? Let's have a bit of a discussion about it. So whenever we talk about the concept of risk, risk is basically when probability could be assigned to an outcome. So that is going to be considered as that the entity is facing a risk. When you could say that this is a 20% chance of X happening, 30% chance of Y happening, 50% chance of Z happening. So that means you are facing a risk. I bet that means what are you doing? You are actually facing a risk. Now what next is there? When we talk about the uncertainty, the concept of uncertainty is that when no probability could be assigned. I bet the probability, when the probability could not be assigned, so you're facing the uncertainty. So what actually happens is that when we talk about the risk, when we talk about the uncertainty. So when we talk about the uncertainty, there are three different type of techniques: Maximax, Maximin, Minimax, Regret. And when you're talking about the risk, so you've got the expected value technique. Now, let's have a bit of a discussion about the concept of uncertainty. So like, let me just guide you a bit that what is actually going to happen with respect to this uncertainty. When you talk about the concept of uncertainty, let's say that you as a company have to decide about a marketing proposal, and you're beginning that you can decide aggressive, you can decide a moderate type of a proposal, or you could decide a low level proposal. Now the outcomes could be that you could have a sale of, okay, the outcomes could be that the demand in the market could be high, could be medium, could be low. So what happens is that we generally create a payoff matrix. And when we create a payoff matrix, there is something that goes on a x-axis, there's something that goes on a y-axis. So just try to understand that this marketing proposal is something that you have to decide. So this is going to be your controllable factor. I bet this is going to be a controllable factor, and this is going to be non-controllable factor. Now let's just try to understand this. If I say aggressive, moderate, low level, high, medium, low. So now what is actually happening is that on this specific scale, I have defined, I've actually put my controllable factors. So like, for example, you adapt, I mean, like maybe let's say 40,000, 55,000, 22,000, 33,000, 47,000, 77,000. 0, 20,000, 13,000, let's say. So what actually happens is that, let's say if you have got this type of a payoff matrix, let's say if you've got this type of a payoff matrix, how exactly are you gonna go about? Just wait a bit. Allah. Okay, now if you have got the approach which is Maximax approach, Maximax is you maximize the maximum output. So you've got aggressive, you've got moderate, you've got low level policy. What you would do is that you would identify the maximum out of each one of them. So you've got 55,000 here. For the moderate, you have got 77,000. For the low level, you have got 0. Now what you would do is that you would maximize the maximum payoff. How would you maximize the maximum payoff? You would say this 70,000 is the maximum out of the maximum values. 77,000 is the maximum out of the 77 out of the maximum values. Okay, the next one of them is basically Maximin. What happens under this Maximin, you identify the minimum values. Let's say for the aggressive, for the moderate, for the low level. The minimum value here is 22,000. The minimum value here is 33,000. The minimum value here is negative 20,000. Now what you do is that you you opt for the one which maximizes the minimum payoff. So again, this maximum policy is also going to lead to the moderate type of a marketing strategy to be adapted. You see, you need to understand the concept that what exactly is it all about. So I think that the student who was having an issue with this actually had an issue that how to plot the controllable, non-controllable factor. So I think now you've got an idea that how to plot the controllable and the non-controllable factors. Right? Okay. There are these other queries that you people raised about transfer pricing, EVA, divisionalization. That's all there in the recordings. Okay, there is one more question that was being asked, that what if we are being asked about the rewards and the pay related and so on and so. So all that I would suggest is that when you talk about the building block model, there is actually this reward block, which talks about the clarity, which talks about the motivation, and which talks about the controllability. Yeah, clarity, motivation, and then controllability. So it actually talks about these three, and these three are going to be the relevant factors which you are going to be just referring to whenever you come across a question which actually requires you to, repeat, which actually requires you to evaluate about yeah, Vedi. Yeah, Vedi, please. Okay. Just wait a bit. I'll just show you how the Minimax regret is going to be done. So when we talk about the Minimax regret, what do? The third thing which we do with respect to this Minimax regret is that we create a regret matrix for this Minimax regret. So now under this Minimax regret, what do? You actually go about this way. You go about this way. You say that which one of them is the highest that we would have earned. Like if there is a high demand, you could have earned 47,000. But you opted for aggressive strategy, and you opted for aggressive strategy means you earned 40,000. So 47,000 minus 40,000 gives you 7,000. 47,000 minus 47,000 gives you 0. 47,000 minus 13,000. When you say minus, it becomes plus. So we are actually trying to calculate regrets. Now when you go about medium, you identify this to be the maximum value. 55 minus 55 is 0. 55 minus 33 is 22,000. 55 minus 20,000 gives you 75,000. Then you've got this 77,000 as a maximum. 77 minus 22 gives you 55,000. 77 minus 77 gives you 0. 77 minus 0 gives you 77,000. Now what happens is that you've been able to identify the regrets. Now what is the approach? It's max regret. Minimize the maximum regret. So what you're going to do is that you're going to identify the maximum value out of this. 55,000, 22,000, 77,000. And then you're going to minimize the maximum regret. So this is the minimum of maximum regret. So that's what you're going to do. It's a minimum of the maximum regret. That's what you're going to do. So hope you people understand this. Okay, so I think we are done now, and I'm just gonna end up over here. Whatever the other areas are, they are actually part and parcel of the recordings, which I've already let you know that where exactly are they available on the website, on the YouTube. So you could actually refer to that, and you could actually try to uh, take this, right? So in case if any further query, yeah, I'll just try to do it after the session. I don't have a mobile phone with me right now, so I'll just try to do it. Yeah, the question could actually test the calculations, and like it could give a scenario where it could say that you might have to apply the different type of decisions, and on the basis of the different type of decisions, you have to actually decide that which specific approach that you have to adopt. Right? Okay, so thank you very much, guys. Thank you for your time. Thank you for attending the session. I will inshallah share this recording, will be updated tomorrow, and plus this handout, that is the today's noting, it will also be made available to you. And for those who are there, I am doing a similar type of session for AFM tomorrow. You may attend it in case if you are doing AFM, or you may recommend your friends to attend it. It's the same time, 9 p.m. I'm doing a similar type of session for AFM tomorrow. Thank you very much, all of you. Thank you for your time. Take care. Bye.